Hey everybody, this is Halstead and Andrew McMillan with REH CPA. Every year, the IRS adjusts certain tax items based on inflation, and they have just come out with their new inflation adjustments for 2025. I've got Andrew McMillan here with me today. Andrew, what can you tell us about what adjustments did the IRS make for 2025?
So a lot of the adjustments they make are in relation to like how much you can put into pre-tax accounts. So a big one is going to be your 401k. So they did increase the amount you can put into a 401k during the year to $23,500. So it's increased about $500 from the prior year. So $23,500 is the max amount you can put into your employer 401k plan. And just another really big change going into next year was from the Secure Act 2.0. That was some new tax law that came out. And if you're between 60 and 63, you not only can put in the $23,500 into your 401k, but you can put an additional $11,250 into your 401k as well. It's called a catch-up contribution. So you can put the $23,500 and another $11,250 into your 401k if you're between 60 and 63. So that's something new to be aware of. For everyone else that you may have heard about the catch-up contribution, if you're over 50, you can put in $7,500 as a catch-up contribution. That amount hasn't changed. That's what we're pretty accustomed to of hearing when you talk about catch-up contributions, that if you're over 50, you can put an additional $7,500 in.
Right.
But just be aware that if you're between 60 and 63, you can put even more in going into next year. Another change they made was for traditional IRA contributions. So if you make a traditional IRA contribution, you may be able to take a tax deduction for that. And your ability to take a tax deduction is based on your income and whether or not you're covered by a retirement plan. So covered by a retirement plan really just means, do you have the opportunity to contribute to an employer retirement plan? Does your employer cover you? Do you have an employer's retirement plan? If you do, then the max you can earn wage-wise and still take a tax deduction for the traditional IRA is $89,000 if you're single, and then $146,000 if you're married. So if you're earning below those amounts and you have an employer-provided retirement plan, you can still contribute to an IRA and actually take a tax deduction for it, a traditional IRA. Some other ones they've increased, like the standard deduction went up to $15,000 for single individuals, $30,000 for married individuals. A lot of the normal inflation adjustments really went up about 2 to 3% or so, it looks like, across the board. We don't have to get into all what the actual dollar amounts are, but the biggest takeaway here is just to understand that if you're making pre-tax contributions to your employer plans, like through your W-2 wages and stuff, make sure you talk to your HR, to your payroll person, that your 401k needs to go up because you can contribute more. Your HSA, your flex spending accounts, your medical saving accounts, whatever type of pre-tax contributions that your employer offers you as a benefit, all of those have been adjusted going into next year. So make sure you're communicating with your payroll department and maximizing those contributions where you can, obviously all in an effort to try to save tax money at the end of the year.
Awesome. Really good information, Andrew. If you guys have any questions on these inflation-adjusted items, feel free to give us a call and we'll help you out. Thank you.